Sanlam, South Africa's largest owned insurer, said normalized headline earnings per share rose more than fivefold as equity markets recovered, boosting investment returns. What it called core earnings per share fell 1% in the 10 months through October. South Africa's all-share index is up 27% this year, recovering from 24% slump in 2008. Sanlam said total new business volumes rose by 2%, while the rest of Africa life insurance businesses performed well. In South Africa, risk underwriting and institutional new business volumes continue to be the main drivers of the overall growth of new business sales. Joining me now, still with us actually, Michael Levine, Senior Investment Manager from Canada Asset Managers, and joining us on the desk is Hein Kruger, CIO of Kruger International. Gentlemen, again, a warm welcome to you. Hein, let's start off with you. Sanlam came out with this trading update today, and it's interesting, this isn't the first time Sanlam has been mentioned. We know that there was a lot of speculation that it had been in talks with BJM. Firstly, let's take a look at the trading update.
Well, the fivefold baffled me and Michael just now a little bit when we chatted about it. And when I had a better look at it, it says that it is relative to the bad time, the comparative time last year. So it's a relative figure and not necessarily fivefoldish. And then one must look at that. But I think the other thing that stands out, and that is that when you look at the money that they've spent, the discretionary capital, since June this year, they said that they are holding back on their share buyback program, which remains suspended. And then the other thing that also came to the front for me was that they said that they have some doubt about the sustainability of the current market levels. Now that is not in the same vein as when you listen to some of their market commentators and some of their fund managers that I get sometimes the feeling are talking up the markets at these levels, and here comes a company and they say exactly the opposite, and at the same time they say that their buyback remains suspended, which means that they regard their own shares as a little bit expensive at these levels probably.
Of course, as Hein said, that they're holding back on buying their own shares. Does this perhaps signal that the company is a little bit cautious about what it'll be doing in the future?
Yes, and I think Hein hits on a good point there. Yeah, a company that typically buys back their shares is clearly seeing value in their own equity relative to any other way that they could maximize their capital. So yeah, if a company comes out and says we're quite not buying back our shares, then I think you can reasonably assume that from their own point of view they regard their equity as at full value. And I think that mirrors their sentiment with regard to the market. You know, the market has run up quite hard since the low of March. The market was at about 18,000. It's now sitting at 27,000. So it's run up hard. Certainly, from my point of view, I think the market is full at the moment. You know, it's trading on a price earnings multiple in excess of 16.5, which is very high relative to what it has been over the last 12 to 18 months.
Hein, you were talking about investors out there talking up their own books, especially when they liaise with the media. Do you think that they have perhaps just been saying what their agenda is, in fact, to not get the markets to sell off?
Well, Eleni, when I look at market commentators and I listen to them, then there's a clear distinction between private investors or smaller investment companies like our own and Canon, for instance, and the institutional companies. And what I also find strange is that virtually the same people who were cautioning people in February, March this year, when it was clearly buying time, they were cautioning people. Those same people are now saying that the market is at good levels and this is where the market should be. And then sometimes I will say, yes, the market is sort of pricing in 2 years ahead earnings, you know, as if you should buy 2 years ahead into earnings, which I don't think is the right thing. So I personally believe that we saw huge inflows since March into institutional books, and that they are afraid to caution people to say, wait a minute, it's getting expensive, and they're afraid that they might see outflows.
Hein, there's a flip side to this, because perhaps some people didn't get in at the right levels, for instance the March lows, and obviously when it was a good time to buy, and maybe they are trying to talk the markets down because obviously they want a good buying opportunity.
Yeah.
Surely that happens as well.
Yes, well, I'll be dead honest about that. I'm hoping that we see a correction that brings the market closer. I think the price is closer to the earnings levels, so that I can spend some money that didn't come in, because we see some money inflows at these levels currently, and obviously you couldn't buy enough at those levels.
Excuse me. What's interesting to me is even if you look before March, if you look at sort of January, February, and you look at the amount of money that was invested in cash funds, cash unit trust funds, and you look at the amount of money that is in cash unit trust funds now, there's not much of a difference. So, you know, there's certainly people, investors in January, February were actually still worried about the market, and they are equally worried now, and yet they've missed out on this performance, and yet the market is now at a fuller value.
Are you buying at these levels?
Well, it all depends really on what sort of investment horizon you're looking. You know, most of our institutional mandates are pure equity, so we are, you know, required to be fully invested at the moment. So, you know, any new inflows we need to invest, and that's where we find value. But we are finding value in the market, but it is becoming more difficult.
You said a word of caution, of course, and JSE all shares gained around 20% so far this year. We know that we saw a little bit of trouble emerging from Dubai, and then it brings up questions about sovereign defaults and, you know, the emerging market space, and whether we'll be seeing risky assets being sold off going forward. Are you exercising caution, Hein, at this stage?
We are definitely exercising caution, but we also don't want to miss opportunities. For instance, if you look at BAT and you look at the 5% dividend yield forward, that is not bad value. So there is value in the market, but it is not like in March and February where you could just climb in and buy virtually anything.
Okay, so which companies are you staying away from? We know that BHP Billiton, Anglo American, Naspers, Standard Bank have been performing really well. In fact, these are the shares that really have been pushing the markets forward. Yeah,
I'm a little bit afraid of gold shares, for instance. I do not trust the gold price at these levels, and I do not necessarily believe it is sustainable, as well as I'm very uncomfortable with the high levels of the rand currently. So it can be sort of a double whammy if it hits you the wrong way. Although I don't see any reason why the rand should weaken at these levels.
We spoke about gold shares a little earlier, Michael, and you were also saying you're relatively cautious. Lonmin and Implats, the top of the top 40 today. Lonmin up 3.6% and Implats again of 3.5%. Would you be staying away from the platinum producers because we know there's good prospects for that industrial metal?
Yes, we would, and that's more a case of we don't have any confidence or any clear visibility in the earnings of the platinum miners going forward in the next 12 to 18 months. So although yes, you've seen an increase in the platinum price, we just are not convinced that you're going to see earnings out of the platinum miners in the next 12 to 18 months.
Very quickly, Hein, would you be staying away from those platinum miners as well?
Yes, for exactly the same reasons. Unfortunately, I can't argue with Michael. I like to have a little bit of a barney here, but it's true. I mean, the international economy has not yet come back to the levels where the prices are.
And of course, it's all been pushed up by artificial stimulus, so a lot of concern there.
And a lot of liquidity.